So here's the big question, right? How in the world do you put a price on something that just doesn't play by the old rules? Generations, investors have had this trusty toolkit to figure out what a company's worth. But then crypto came along, this whole new digital frontier that doesn't have earnings or sales or even a physical office sometimes. So are we really seeing the birth of a totally new revolutionary asset class? Or is this whole thing just a house of cards waiting to fall? That's the core dilemma we're going to unpack today.
Okay, let's just dive right in with this quote. It's powerful, and for a lot of people, pretty controversial, but it gets right to the heart of the skeptical argument. The thinking here is pretty simple. If an asset doesn't generate cash flow, if it doesn't create some kind of real, tangible value, then you're not actually investing. You're just speculating. You're just betting that a greater fool will come along and buy it from you at a higher price. But is that really the whole story? Or are there maybe new kinds of value being created that this view just completely misses? That's what we're here to figure out.
So here's our game plan for this explainer. We're going to start on solid ground, in the traditional world of investing. Then we'll jump into what makes these crypto assets so darn different. We'll look at the huge debate over how to value them, learn some tough lessons from a few catastrophic failures, and then finally, try to build a framework for how you can think about this space going forward.
Right. Let's start with what we know. Before we can really get why crypto is such a headache to value, we need to get a handle on the basic tools that investors use for normal companies, the ones that actually produce cash. Because that cash flow, well, that's the bedrock of all traditional valuation. First up, the classic, the price to earnings or PE ratio. Let's make this super simple. Imagine you're buying a local coffee shop, and it makes, say, $10,000 in profit every year. If you pay $100,000 for it, its PE ratio is 10. Pretty simple, right? You're paying 10 times what it earns in a year. A high PE usually means investors are betting big on future growth, while a low PE might signal a bargain. It's the most basic question you can ask. What am I paying today for the profits of tomorrow?
But what happens if a company isn't profitable yet? Think of a brand new, fast-growing tech startup. They might be burning through cash, so there's no E for a PE ratio. That's where the price to sales, or PS ratio, comes in handy. It tells you how much investors are willing to pay for every single dollar of revenue, basically betting that those sales are going to turn into massive profits someday.
And finally, we've got a metric the real pros love, EV to EBITDA. Let's break that down real quick. Enterprise value, or EV, is the total buyout price for a company. So it's stock value plus all its debt. It's the true cost to own the whole shebang. And EBITDA? That's a fancy way of saying a company's raw cash-generating power, before all the accounting stuff like interest and taxes. By comparing the total price to its raw cash flow, you get this really clean apples-to-apples comparison between different companies. That's why it's so powerful. So here's the main takeaway. Traditional valuation, it all boils down to this really clear relationship. You look at the price, what you pay, and you compare it to the underlying value of the business, what you get. Whether that's assets or sales or straight-up profits, there's a tangible link between the stock price and how the business is actually doing.
Okay, now that we've got our traditional toolkit, let's step into a world where those tools, well, they start to break down. We're about to enter the disruptive, often confusing universe of crypto assets, where that clear line between price and real-world value gets a whole lot blurrier.
At the absolute core of crypto is this wild idea, tokenization. The concept is that you can take just about anything of value, a building, a famous painting, heck, even your own future earnings, and you can create a unique digital deed for it that lives on a blockchain. It's like having a digital certificate of ownership that can be bought, sold, or traded anywhere in the world in seconds with no middleman. It's a pretty revolutionary idea.
And how are these digital deeds kept safe? Well, through the technology you're looking at right here, the blockchain. Just think of it like a shared public record book that everyone can see but no one can change. As you can see, when a transaction is requested, it gets validated by a whole network of computers. They bundle it together into a new block and then permanently add it to the chain. This whole decentralized system means no single person or company is in charge, which makes it incredibly secure and transparent.
And this, right here, perfectly illustrates the fundamental problem. A stock is simple. It's a legal claim on a company's future profits. A token, on the other hand, well, it can be a lot of different things. It might be a governance token that lets you vote on a project's future, or a utility token that acts like a key to access a service. Its value isn't necessarily tied to profits, but to squishier things like how popular the network is, and simple supply and demand.
This brings us straight to the heart of the whole debate. When you consider these massive differences,
Can we even try to use our old investor's toolkit on crypto? Or is it like, I don't know, trying to measure temperature with a ruler? This is the great valuation debate.
And there it is, the problem in a nutshell. The entire foundation of value investing is built on earnings and cash flow. But what do you do when the thing you're trying to value is a decentralized network that's specifically designed not to have a central company collecting profits? How do you figure out its real intrinsic value if there are no profits to measure in the first place? That's the crypto valuation dilemma. And this brings us right back to that skeptical argument from the beginning. This viewpoint says that, look, without a clear way to make money, these crypto assets are basically no different from collectibles like art or Pokemon cards. Their price isn't based on what they do, but purely on supply and demand and the shared belief that, hey, their value will go up. Now, this whole debate isn't just some academic exercise. We're talking about billions, even trillions of dollars on the line. So to really see why this matters so much, let's look at what happens when these flawed valuation models crash into the real world. Let's see what happens when hype meets a very harsh reality. Just look at this number, 19.5%. That was the annual interest rate you could get from something called the Anchor Protocol, just for depositing a stablecoin called Terra USD. Now, let me put that into perspective for you. The long-term average return of the stock market, which is considered risky, by the way, is somewhere between 7 and 10%. This thing was offering double that for what it claimed was a low-risk asset. A number like that should set off massive alarm bells for any investor. In finance, there is no such thing as a free lunch. Promising a nearly 20% return with low risk is one of the oldest red flags in the book. It almost always means the real risk is just hidden somewhere you can't see it. And the result was an absolute catastrophe. The system was designed so that one token, Luna, could always be swapped for $1 worth of the stablecoin, Terra USD. So when Terra USD's price slipped just a little, the system went into overdrive, printing trillions of new Luna tokens to try and prop it up. This caused insane hyperinflation and triggered a death spiral, sending Luna's value to practically zero. Over $40 billion in value just poof, gone in less than a week. And here is the brutal truth of the matter. This wasn't just bad luck. It wasn't a surprise market event. The underlying economic model was so flawed that critics were calling it a death spiral bond in disguise. The design itself was fundamentally broken from day one. Its collapse wasn't a question of if, it was always just a question of when.
Another really good cautionary tale is Axie Infinity. It was hyped up as the future of gaming, this play-to-earn model. But its whole economy was based on rewarding early players with tokens, which they would then sell to new players who needed those tokens to start playing. You see the problem? The system needed a constant flood of new money from new players just to pay off the old ones. It wasn't a self-sustaining economy. It was a machine that needed to be constantly fed new users just to keep from collapsing.
Okay, so if the old tools don't work and the new models can be incredibly dangerous and flawed, how do we move forward from here? We need a new framework, one that isn't based on old formulas, but on first principles and just plain old critical thinking. The way forward isn't some magic new formula, but a framework for asking the right questions. Instead of asking, what's the price, we need to start asking, where does the value actually come from? First, utility. Is this token a tool that people actually use? Does it do something useful? Second, revenue. Is the project generating real income from fees, or is it just an illusion? Third, sustainability. Are those amazing yields coming from a real business, or are they just printing new tokens to pay people off, like Axie Infinity did? And finally, risk. Is the underlying code a solid foundation, or is it a flawed structure just waiting to fall apart like Terra/Luna? And that leaves us with the final, and I think most provocative question that hangs over this entire industry. Is this incredible new technology laying the groundwork for a more open, decentralized financial system for the future? Or is it just creating a more elaborate, unregulated casino? The honest answer, for now, is probably a little bit of both. The great challenge and the great opportunity is to sift through all the casino noise to find the projects that are quietly building that new financial system. Figuring out which is which, that's going to define the next decade of this technology.